If you watch YouTubers or read news articles or even talk to other mortgage brokers, you'd already know by now that the penalties to break a variable rate mortgage are often better than the penalties to break a fixed rate mortgage. In fact, some would go so far to say that variable rate penalties always beat the penalties that you would pay in a fixed rate scenario. But what if that wasn't always true? Well, this video is going to come as a shock to a lot of people out there, including a lot of other mortgage professionals, because in this video we're going to cover how it's possible that the variable rate penalty that you thought was going to save you more money may actually cost you more than some fixed rate penalties in some certain scenarios. Hold on to your suspicions because this isn't clickbait.
Oh my word, life is full of surprise.
Now, to start getting an understanding about how this could possibly be true, it's first important to acknowledge just how different some fixed rate penalty calculations can be, and in general, what those penalties are trying to achieve. Now, you may already know that fixed rate penalty calculations are generally determined by either 3 months interest, so that's when you take your mortgage payment, it's divided into two parts: principal, actually paying the loan down, and interest, that nice expensive thank you we give to the bank every month. It's that interest component, essentially times 3. That'll get you close enough. But it's the 3 months interest or the interest rate differential, also known as the IRD. And then the 3 magic words that make the bank the most money ever, whichever is greatest. The banks and mortgage lenders are always going to take the penalty calculation that produces the largest result for them. And in knowing that, we start to feel like we're understanding what's going on here. But that tends to be a gross oversimplification of fixed rate penalties in general. And here, the details matter. Now, before continuing on, it's important to acknowledge that there are actually additional ways that your fixed rate mortgage penalty could be calculated. Some lenders, in fact, will even give you a slightly lower interest rate if they're allowed to include an administration fee type penalty. And when you pay those types of penalties, it means that you're going to pay somewhere in the neighborhood of a 2.5% to 3% of the overall mortgage balance as your penalty. Now, that's unless, of course, that the interest rate differential doesn't end up being higher, in which case you end up paying that one. Before you sign the dotted line on any mortgage, you better understand how your penalties are calculated, because you can imagine how you're going to feel when you find out that you have to pay 3% of your mortgage balance as your penalty.
Emotional, damn it!
Fortunately, these types of additional mortgage penalties aren't all that common, but it's still easy to see why so many people create this generic statement that a variable rate penalty always beats a fixed rate mortgage penalty. After all, in the fixed rate scenario, when you're always taking the largest of the two penalties, how could you ever beat a variable rate penalty, which is almost always 3 months interest? We're getting there. The next thing that you have to understand is that not all fixed rate penalty calculations are created equally. Even though banks and mortgage lenders will have an interest rate differential, an IRD, and they go under the same name, there are vastly different ways that that interest rate differential penalty can be calculated. In general, though, you can simplify all of these different IRD calculations into 2 separate categories: big bank mortgage IRDs and monoline versions of the IRDs. Here's why the difference matters. Let's say that we locked you into a 3% fixed rate mortgage and rates go down to 2%. Well, now you're in a situation where if you wanted to break the mortgage, not only does the lender incur administration fees for handling the paperwork in that process, but unfortunately for the mortgage lender, it also means that they're getting their money back. And that's a problem, because as soon as they get their money back, they can't loan it again back out at 3%. They are stuck lending it out at the market rate, which just happens to be 2%. So because you have decided to break your mortgage, the bank is going to suddenly make less money. And as we know from the past videos that I've made, banks are not charities. And that's where the penalty comes in, to make up for the difference in the profits that they would have made had you stuck in with your current mortgage. Here is where it gets a little bit more complex though, because the rate that you negotiated in your contract, that's known as the contract rate. But what they're comparing you to is the comparison rate, which is the interest rate for the most like term of the current market rate. In other words, if you have 4 years left in your 5-year fixed mortgage, they're going to be comparing your contract rate to whatever the current 4-year fixed mortgage rates are. If you have 3 years left in your current 5-year fixed mortgage, they're going to compare your contract rate to the existing 3-year fixed rate mortgages. This tends to bump up your penalty a little bit, because as the difference grows between your contract rate and the comparison rate, so too does your penalty. But here is where the big bank version of the IRD differs. Because in their calculations, they're not actually comparing you to your existing contract rate, the rate that you're paying your mortgage at, like in the case of the monoline example earlier. No siree. Instead, what they do is they compare you to their much higher posted rate, and this jacks the penalty way up. Now you might be like, where the hell did this posted rate come from? Well, all banks have posted rates. These are the standard rates that appear on their websites, and they are high and far from competitive. So what happens is when you walk in and say, hey, I need a mortgage, I've been a loyal customer for years, they say, well, gosh darn it, we can't give you the higher posted rates. Instead, we're going to give you these special rates. Or if you come in from another institution, another bank, and you say, hey, look, I need a mortgage, they say, well, we're trying to steal your business from your bank that you're loyal to. We can't give you the posted rates. We're going to give you these special rates. And then you walk away feeling like a master negotiator, like you've done yourself a solid. The problem is that when it comes time to calculate the penalties, the banks say, hey, do you remember when we were friends to you and we gave you these lower special rates? Well, now when it's time to calculate your penalty, we'd like you to be our friend as well. And when we calculate that penalty, we'd actually like to use the higher rate instead of the contract rate. We'd like to use the posted rate in your penalty calculation. So these banks will actually use the posted rate instead of your contract rate when trying to calculate the penalty. And then all of a sudden your penalty shoots way up. So the first key to all of this is, if you're ever going fixed, avoid the big bank versions of that IRD calculation. But what if rates aren't going down? What if instead rates start going up, like in the environment that we're in right now? Well, that's when things start getting a little bit more interesting, because now you're in a situation where the lenders might actually want their money back. Because if they have you locked in a 2% fixed mortgage rate, but they can get their money back and the next day loan it out for 3%, then they're actually ahead. Of course, they'll still have the administration charges that they'll have to cover, which of course you'll pay on the 3 months interest penalty that you'll have to pay. But overall, everyone's a winner. Well, sort of. Remember, we said there's two different versions of the IRD. In our example from before, let's say you got the 2% interest rate and the comparison rates go up to 3%. In that case, your monoline IRD penalty would actually be negative because the lender would have more to gain by taking your money back and loaning it back out at a higher interest rate. So in this case, your largest penalty would actually be the 3 months interest. It's not quite the same story with the big bank version of the IRD though, because on paper they gave you a discount off their posted rate. They're still comparing you to the posted rate in their penalties. You're still stuck paying a much larger penalty than if you had been clever enough to avoid getting a fixed rate mortgage at a big bank. Now let's pause the conversation on fixed rate penalties for a second. Let's talk about variable rate mortgages for just a brief moment and then come back and tie it all together. It's true that the variable rate mortgage penalty calculation, unless the lender has done something sneaky, is going to be 3 months interest. But here's where I want to ask you. 3 months interest based on what interest rate? Because here the answer might surprise you. Not all lenders have the same policy on this. When you're given a variable rate mortgage, you are given an interest rate that is based off that bank's prime rate, which in turn is heavily influenced by the Bank of Canada's key lending rate. In most of the recent modern day mortgages, that typically presents itself as a discount to prime. So if prime is 2.45% and your discount is prime minus 1%, your mortgage rate would be 1.45%. As a result, a lot of people assume that when they go to break their variable rate mortgage penalty, that they're going to pay it based off an interest rate of 1.45%. But that's not necessarily true. In fact, a lot of the lenders will actually opt to use something closer, if not actually use their internal bank's prime rate. So rather than have your penalty be based off 1.45%, that they'll actually base their penalty off something closer to the 2.45% that the internal bank prime rate is. And so here is where it gets interesting. Because as you may have noticed before, when the fixed rate penalty is using the 3 months interest calculation because of rising rates, it's actually using the contract rate to determine this. And in this example, that's lower than the prime rate that the variable rate penalty calculation is using. So in this example, the variable rate penalty is actually higher than what you'd pay for on a fixed rate penalty. But it gets even more interesting than that, because as rates rise, your fixed rate penalty eventually decreases to the point where it's just your 3 months interest, and it flattens out at the contract rate that you had previously locked in and negotiated. Conversely, as rates rise, your variable rate penalty actually increases. With each and every quarter point increase in the Bank of Canada rate, your penalty in turn continues to climb. Now I say all this, but I want you to hold two things in mind. The first is that yes, in a flat or declining rate environment, it is true that variable rate penalties will almost always outperform fixed rate penalties. But in an environment where rates are climbing, that isn't necessarily true. The second is that people who have sipped the variable rate Kool-Aid or the fixed rate Kool-Aid for too long might forget that the other option exists. It's incredibly important to remember that no matter what market you're in, there is a case for variable and there is a case for fixed, depending on your specific circumstances and your long-term goals. Now, a majority of people might fit into one specific category, but there's always going to be a case why one might be the better fit for someone else. And a good mortgage broker is going to be able to help you determine that. And on top of that, if someone tells you that this is all impossible, I can tell you firsthand that it's not. Last year, when we had the opportunity to lock in a bunch of people at 1.39 to the 1.59% 5-year fixed mortgages, a lot of the penalties on those mortgages already in today's present day would outperform a lot of the variable rate calculations, or at the very least come very, very close. So not only did these people get to lock in these lower fixed rate mortgages, but they ended up in a situation where they don't have to be afraid of the big penalty boogeyman that so many variable rate champions are afraid of. They ended up in the best possible scenario, and you could too.